Hey, just want to say hi and thanks for coming. We appreciate you.
Nice to meet you.
Good to see you.
Thank you. Nice to meet
Good to
you.
see you. Thanks for coming. Susan, you don't want to come up to the podium when you're done here? You're going to talk from here.
I've got it.
Oh, yeah, well, you're in good shape. Good morning. Appreciate everybody coming. I know that it's very important. I'd like to welcome you, and I'd also like to thank New College. They've been very good about helping us host meetings at here in USF and in the Ringling. We've done a lot of different events, but it makes it convenient. So I used to have 5 counties I represent. Now I've got 2, all of Sarasota and 98% of Manatee County. So University is a good place, Boulevard anyway, is a good place to meet. I'd also like to thank our panelists for being here. Appreciate the opportunity. I know we had an event a couple of weeks ago, and we were hoping to get you down from FEMA before, and I know you got tied up, but we're excited about having all of you here with us today. Let me just say that the whole thing on insurance is a big issue to not just Sarasota, Manatee County, but across the state and really around the country. Even when you think of Colorado, they had flooding and issues that are there. But obviously, everybody in this area is very, very concerned. Our purpose today is we're going to have our panelists open it up and say a few things, and then our goal is to take any questions or comments that you have and your concerns, because I know a lot of you in the room that have a lot of concerns. Last week, I think it was, or the week before, I'm one of the chairman or co-chairman of the Florida caucus. We have the 3rd largest congressional delegation in the country, 29 members, including the 2 members in the Senate. And we had a very good turnout, and we were talking about flood insurance. I think we had the number 2 person from FEMA there. So this isn't a political issue, one party or the other. I can tell you, Democrats and Republicans across the board as it relates to Florida are 100% about trying to get something done, and I think we will get something done, but we're working together. We're all concerned about, and we've all heard, 400% or 500% increases. I've heard as high as 1,000% increases. Completely, totally unacceptable. And one thing you might not know is that Florida has about 40% of all the policies for FEMA, and yet, the challenge we've got, we're $30 billion or $27 billion in debt. And that's partially because of Katrina and Sandy, what happened up in New York. You don't even think about New York getting hammered as they did, but obviously they did. You do think about Florida. But we've been paying in a lot of those premiums over the last 4 or 5 years, knock on wood. We haven't had those challenges, but we've got to have something that makes sense. One gentleman, I think probably in the audience, he was there the other day, and this is what we hear all the time. His flood insurance was $988. Now it's $5,600. So that's a typical 500, 600% increase. That's just, that can't happen. That can't be, we've got to deal with that in a big way. The other thing we are pushing on a bipartisan basis, legislation. It's bill number HR 3370. If you'd like to look at it, I'd like to get your thoughts and input. But the idea is to delay the rate increases and get this affordability study done that we've been promised as a part of this bill. And again, I don't want to, blame anybody. I just want to get it done. I want to find a way we can come together, FEMA, members of Congress, and the community, and figure out what makes sense in terms of going forward. So with that, I'd like to introduce our panel today. I'm very excited to have our first speaker, the Chief of FEMA for Floodplain Management in the Insurance Branch, Susan Wilson. So Susan, if you will, I'll let you lead it off, and then I'll introduce our other 2 guests. Let's give her a round of applause. And I think we'll let everybody make their remarks, and then we'll open it up for questions and comments.
And thank you. I have a few brief PowerPoint slides that will go over just the basics of Biggert Waters 2012, or BW12 as we've come to call it. I thank you for the opportunity to come to Sarasota County. It was nice to be able to leave wet, rainy, cold Atlanta yesterday and come to sunny South Florida. So let me just preface my remarks by saying this is really the biggest change to the flood insurance part of the National Flood Insurance Program, really since its inception. I just started my 31st year with FEMA a couple of months ago, and I can tell you that this is the biggest change to the insurance side of the house. I'm distinguishing between the insurance side of the house and the other part of the program that goes hand in hand with making insurance coverage available in communities is the floodplain management program that is a requirement for communities to participate in the program. So let's start with the program. There's my clicker. Okay.
I'll take that off.
Oh, that's
Just
okay.
to give you a little more room. There you go.
Okay. So first of all, the President Obama signed Biggert-Waters 2012 into law on July 6th, 2012. Now, one of the good things that the bill did was it reauthorized the National Flood Insurance Program for a full 5 years. So it's actually going to be authorized, and remember that this is a government program, so it depends upon the Congress to reauthorize the program. So in the past couple of years, we've had some lapses in the program where there was a delay or the program wasn't reauthorized. So during the hiatus or the time when the program was not authorized, that meant that any policies that were in force ran to their renewal and couldn't be renewed. Now, when Congress went back and reauthorized the program, they made that renewal retroactive. So that was not a problem, but it did delay some people in being able to get flood insurance coverage, and it impacted people's ability to get mortgage loans, because if you're in a special flood hazard area, the mandatory purchase of flood insurance is something that's been required. That was also passed by a congressional act back in 1973. So if you're in a special flood hazard area, and those are the areas that are defined as being at high risk of flooding, subject to a 1% annual chance of having a flood event that is equaled or exceeded, it's what we call the base flood, or we're trying to get people away from talking about the 100-year flood, because that gives folks a misunderstanding. They think, well, if we had the 100-year flood this year, we'll never live to see another one, so we don't have to worry about it. But in fact, the base flood is actually a probability that you have if you're in that area that's defined as being at a high risk of flooding. You have a 1% or greater annual chance of having a flood event that equals or exceeds that level. So the Biggert-Waters 2012 did reauthorize the program through the end of September 2017. So what's changing? This is what's changing as written into Biggert-Waters 2012. The subsidies are being phased out. Now, these are subsidies that have been people that are in older buildings. These would be buildings, in the case of Sarasota County or Manatee County, these would be buildings that were permitted and built before December 31st, 1974. So anything that's built before that date is considered to be pre-flood insurance rate map, pre-firm. Anything built after that date is assumed to have been built with the knowledge of how to build to make that building reasonably safe from flooding. So up until this time, for the first 45 years of this program, then those older buildings have enjoyed subsidies. In other words, they were not paying the risk-based rates for that insurance coverage. In fact, they were paying about 50% of what that estimated actuarial rate would be. So Bigger Waters calls for the phase out of subsidies for non-primary residences, for business properties, and for severe repetitive loss properties. Now, these would be 1 to 4 family residential buildings that have had 4 or more paid flood insurance claims, or that have had claims where the payments exceeded the fair market value of the building. So the subsidies would be phased out. Now, the bill also calls for new policies to be issued at full risk rates. So the tripwires for that are after the sale or purchase of the property, if the policy lapses, if there was no no flood insurance coverage when BW 12 was enacted. So in other words, if there was no policy on January 6th of 2012, then if somebody went to buy a policy, they would be rated at full risk rates. The other thing, and this is nothing new, after the building has been substantially improved or substantially damaged, it becomes treated as if it's new construction. Now, this is not something new with Bigger Waters. This is the way the program has always been structured. So really, it was trying to give property owners a kind of a break when they bought or improved by less than 50% a building that predated the date of the first flood insurance rate map. So other things that are included in Bigger Waters, and we'll talk about this a little more in a couple more slides, is that grandfathered rates are also proposed to be phased out under Bigger Waters. It's a different section. Now, these grandfathered rates are the discount that's currently being provided to those post-firm buildings that were built under a previous map. So the next time, for example, the next time after Bigger Waters is enacted, the next time a renewal comes up, then there would be a gradual phase out of the discount that's provided because that building was built in compliance with the map in effect at the time of construction. So let's break that down a little bit. Right now, and this slide represents the nation, and currently we estimate about 81% of the policies in force are paying actuarial risk-based rates. Now, the Florida statistics are very similar to the national statistics. So what are we talking about? About 19% of the policy base would be impacted by the provisions of Section 205 of Bigger Waters. This is the phase out of those subsidies for the older buildings. Now, so we'll break that down a little bit further. Pre-firm, non-primary residences, business properties, and those severe repetitive loss properties represent about 5% of the policy base. About 10% of the policy base are pre-firm primary residences. These will not be affected by Section 205 of Bigger Waters unless the property is sold, the policy lapses, or a new policy is purchased on or after July 6th of 2012. And that leaves another 4% of the policies which have not, these are pre-firm condominium or multifamily buildings. Now, those have not been addressed. That's going to take a little bit more work in terms of what needs to be done to implement Biggert Waters for those multifamily and residential condominium buildings. Okay, so let's talk about non-primary residences. So this is one of the first group of buildings that will see the phase out of the subsidies. So rates will increase by 25% per year until they reflect full risk rates. Now, one of the problems with pre-firm, these older buildings, is when they took the subsidized rate, there was no elevation certificate provided to calculate the rates. So many of these older buildings we don't know what the risk rate would be. So one of the things that we're recommending is that people that own the non-primary residences or any of these other structures that will be impacted by the phase out of the subsidies need to consider getting an elevation certificate prepared as soon as possible, so that then you know what the full risk rate, and you can talk to your insurance agent about what that rate will be. Now, those changes became effective for policies when they renewed on or after January 1st of 2013. So we've already talked about what constitutes a pre-firm structure. So let's also talk about how non-primary residence is defined. A building that is lived in by the insured or the insured spouse less than 80% of the year. So on the flip side of that, then a primary residence would be where the insured or the insured spouse occupies the residence for 80% or more of the year. So what are the other changes? Now, these changes began to be implemented, began to be implemented on October 1st of 2013. And this is to phase out the subsidy by 25% increases for pre-firm commercial buildings. So these would be ones that are non-residential buildings. As I also mentioned before, the rates for repetitively flooded structures, these would be 1 to 4 family residential buildings where they've had 4 or more flood claims, or they've had flood claims that exceed the fair market value of the building, beginning at the renewal on or after October 1st of 2013, they would start to see a 25% increase per year until the rates get to be the risk-based rates. So once again, on these older buildings, we don't really know in many cases what the full risk rates would be because there is no elevation certificate on file for those buildings. So when would primary residences move to full risk rates? So if a new policy is written, if the policy lapses, if they didn't have a policy when the BW12 was enacted July 6th of 2012, and they went to get a policy on that pre-firm residential building, it would be rated at full actuarial rates. Also, when the property is purchased or sold, it goes to full actuarial rates. These changes began to be implemented, once again, on October 1st, 2013. Okay, so impact on NFIP policies. One of the things that the insurance policy never asked before was, is this your primary residence? So now when the policy renews, the policyholder will be asked to designate whether this is the primary residence or not. Also, the policyholder may be asked for other information at the policy renewal or when it's issued, such as the elevation certificate. People who have a preferred risk policy, does anybody in here have a preferred risk policy? Okay, got a couple preferred risk policies. That's a highly discounted policy that's available to buildings that are in the non-special flood hazard areas. Those would be areas that are designated as zones B as in boy, C as in Charlie, or X as in X-ray on the current effective map. There are also some eligibility criteria, but the policyholder may be asked to provide documentation to confirm their continued eligibility for that highly discounted preferred risk policy. So up until this point, we've been talking about Section 205 of Biggert Waters. Now we're going to talk about Section 207 of Biggert Waters. This would be the call for the phase out of the grandfathering discounts. Now, once again, up until this time, the rating has given special consideration to buildings that were built in compliance with the map in effect at the time of construction, provided that those buildings, the floor level hadn't been changed, you hadn't converted the lower level enclosure into the family room, and that the building had not been substantially improved or substantially damaged. So Biggert Waters Section 207 calls for, and it's estimated that it will begin to be implemented in, oops, hit the wrong button again. Okay. It's estimated that provisions will begin to be implemented in October of 2014. This would mean that when a community received a new flood insurance rate map and it changed the elevation from what had been used for the rating elevation, then 20% a year over a 5-year period would phase in the difference between what they had been paying based on the old map and what they would be paying using the current effective map. So that, let me emphasize that that has not yet been implemented. It's estimated that it will begin in October of 2014. So Des and Sandy may have a little bit better information about when the next maps will become available in this area, but that would mean that when this provision of the bill was implemented, then the next revision to the flood insurance rate maps would trigger the beginning of the phase out of the grandfathering. So, and I probably should have put this at the beginning. I spoke a little bit about the flood insurance program, but it did begin with an act of Congress back in 1968. It ties together the availability of flood insurance coverage in a community to the community's voluntary adoption and enforcement of a local program of floodplain management. Now, currently we have 460 communities in Florida that participate in the program. There are only a handful of communities in Florida that have a mapped and identified flood risk that do not participate in the National Flood Insurance Program. Currently, there are just over 22,000 communities nationwide that participate in the National Flood Insurance Program. Now, so in exchange for the community implementing that local program of floodplain management, flood insurance coverage, which is federally underwritten, becomes available throughout that community, not just in the high-risk flood areas. So it becomes available throughout that community. So currently, as I said, there are 460 communities participating in the state of Florida. We have over 2 million policies in force in Florida. As Representative Buchanan said, we've got about a little over 38% of the policy base in the country is here in Florida. And since 1978, the program has paid $3.7 billion worth of claims in the state of Florida. One of the other things that should be mentioned, one of the ways to offset Biggert waters is through the community rating system. And this is also a voluntary program that FEMA implemented back in 1990. And this is to give communities an opportunity through premium discounts to recognize communities that implement a local floodplain management program or related activities that benefit the community, making it a safer community, more resilient community. The CRS program has 18 classes of activities that are can earn credit. The program is structured so that every class rating results in an additional 5% discount for policies that are in the special flood hazard area. So let's look at a little bit about the local area. Now, Florida has the largest number nationwide of communities participating in the community rating system with 216 communities. Now, currently we have 18 communities that are at a CRS Class 5 level, which means that any policyholder in the special flood hazard area receives a 25% premium discount based on that community's implemented activities. Now, currently in this area, Anna Maria, Manatee County, Sarasota County are all at a CRS Class 5. So that 25% discount. Now add on to that Bradenton Beach, Bradenton, Holmes Beach, Longboat Key, North Point, City of Sarasota, and Venice are at a CRS Class 6, which means that those communities receive a 20% premium discount. Now, the city of Palmetto is a CRS Class 8. I didn't, I just looked at the communities in Manatee and Sarasota counties. So Palmetto receives a 10% premium discount. So other ways that property owners can reduce the premiums they're paying for existing newer construction, post-firm construction, verify that the building has adequate flood openings. So if you have an enclosure, a garage, or a crawl space, make sure that you have adequate flood openings that allow for the equalization of hydrostatic pressure. that will reduce your insurance premium. Other things that you can do, make sure that your machinery and equipment that are servicing the building is elevated to or above the base flood elevation. That also is something that adds a loading factor on the insurance when the premium is calculated. And make sure that the area below the lowest floor is unfinished and used only for storage, parking of vehicles, and building access. So let's talk about, just briefly, about the velocity zone areas. These would be the coastal areas. These are areas that are subject to a 3-foot or greater breaking wave and the erosion potential for them. Now, things that a community or a property owner could consider that might reduce their insurance premium in the velocity zone would be considering limiting the size of the enclosure to no more than 299 square feet of breakaway wall construction. The larger the enclosure, although it's allowed under the flood insurance program, the more expensive the premium will be. The best insurance premium for V-zone construction are when the area below the elevated floor is free of obstruction. And once again, the area below the elevated floor should be used only for parking of vehicles, storage, and building access. Okay, for those pre-firm structures, the ones that are going to be affected by Biggert Waters Section 205, the phase out of the subsidy, we highly recommend obtaining an elevation certificate as quickly as possible. If an owner is doing any kind of improvement, talk to your local floodplain administrator about what you can do to elevate or otherwise retrofit the building so that it's more flood resistant. Add your flood openings to the crawl space, garage, or enclosure, because this was something that was not required by the National Flood Insurance Program until 1986. So some other older buildings do not have those flood openings. And finally consider elevating that utility equipment so that it's at or above the base flood elevation. And the last thing that you can do as a policy holder is you can elect to have a higher deductible on your insurance policy. Like any insurance policy, you have standard deductibles, and then the flood insurance program has higher optional deductibles. Now, the only catch may be that if you do have a mortgage loan, your mortgage lender needs to approve that higher deductible that you've decided to elect. Now, the higher deductible does have the result of lowering the premium, but when it comes to claim time, you do have more out-of-pocket expenses before you can make the claim. So that is a very brief review. Now, this is a list of some of the resources that are available on Biggert Waters. There's a lot of really good information. This is the main web page for Biggert Waters. There's also a lot of good information on floodsmart.gov. And finally, here are some contact information. Now, Joy Duprault unfortunately couldn't be with us today, but she is the NFIP State Coordinator for Florida. She's in Tallahassee, so she and her staff are a good source of information and assistance. Janice Mitchell is the Region 4 FEMA insurance specialist. And finally, my contact information.
Thank you, Susan, for that excellent presentation in terms of information. I want to take just a couple of minutes because I want to get a chance to have some of our local folks here get a chance to get questions and comments. So maybe we'll start with Sandy Tudor for the Manatee County Floodplain Manager. If you could take, I'm going to ask you to keep it fairly brief, like 3 or 4 minutes each if you can. Appreciate it.
My name is Sandy Tudor, as he said, with Manatee County. We are getting new maps. Our new maps will be effective at the latest by March 17th, 2014, or upon adoption of a new floodplain ordinance. The majority of the maps are not actually changing drastically from what was previously seen. They took the older maps and just overlaid them and digitized them over aerials. There are some areas that changed. So if you have any questions, I would recommend you could give Manatee County a call. The number is 748-4501, and you could ask to speak to either me or somebody else in the floodplain section, and we'd be glad to answer any questions you have on the new maps.
Thanks. And quickly from Sarasota County, the Community Rating Systems Coordinator, Des Companion.
Good morning and thank you. As a full-time CRS coordinator, I want to just highlight some of the resources available in Sarasota County. We currently have 45,324 NFIP policies in force. Because of our educated public, over half of those are in that special preferred area, which means our educated public knows that we have 2 sources of flooding here. One is a 10-inch rainfall in 24 hours is equivalent to the 100-year storm. Unfortunately, we have experienced some of those events, and also our coastal areas. We have $15 billion in protection in those policies. And as a Class 5 community, we received $7.1 million last year in just discounts alone for that year. That doesn't come to the county, that's in your pocket. One of my big concerns about the changes is the mitigation protection we have in place should an event hit. I feel that's extremely important to us for recovery. Resources available at the county include, I will do a site visit. I don't believe in blanket flood zone information. As an individual, you deserve our full attention. We have 20 to 30-year-old map products that won't be updated till 2015. During that time, though, due to shortcomings in the maps and changes in stormwater drainage projects, which we've had many, instead of changing the maps, people are allowed to do letter of map changes. We have thousands of those in Sarasota County over the 20, 30 years. So if you need, I am available to assist you personally on what's going on with your property. It's a combination of things that may impact you for a flood event. I'd rather be contacted prior to a flood event and to help you solve your mitigation needs now. Thank you. Our number is 861-5000.
Thanks, Des. Let me just, one comment, because people ask me this, and I've looked at it. Being at the Miami Hurricane Center, when we were thinking about building on the water, they track hurricanes back to 1925. And just from a risk assessment, when I looked at Sarasota, Manatee County, if you look back historically, the East Coast gets hit a lot more. North of Tampa, the Panhandle gets a lot more. Is there any consideration, just looking at from a risk standpoint? Because we seem to be out of any place in Florida, because the hurricanes a lot of times come out of Africa. They'd have to come around the Keys and then back up and back in. Now, we did have Charlie, but since 1925, I think there's been 1 or 2 here. There's been a lot more in other places. Does that get taken into consideration?
I actually have the flood history on our Sarasota County website. And I looked up any storms that hit that NOAA's tracked. We've actually had 77 storms. Some of them have been 100 or more miles away, but we've had damages. We've had over $25 million just in the National Flooding Program damages in Sarasota County alone. And yet our last...
Define storms, just out of curiosity. I mean, is it a hurricane? Is that what you mean by hurricane?
They call them tropical storms. Some are no named, but an event large enough to cause damage, either wind or flood.
I guess my question is that taken into consideration, different parts of the state? the amount of storms from our county to Palm Beach County or something like that, or Dade County?
I think
Or
you
not?
might be asking two different things. I don't understand how the insurance actuarial, that risk stuff happens.
Yeah, that's what I was
Those
trying
are
to
those
think.
really smart people. I don't know how they calculate all that. But on NOAA, they do track the storm history, and then I've tried to capture that for our
Okay.
community.
Thank you. And let's turn it over to the audience. And how are we going to do this, Danny? So we got a mic? Yeah, raise your hand, anybody that, first one right here, the gentleman in the back. Danny's got the mic.
Yes. Yes, thank you. My name is Rich Olivari. Own a condo in Venice. So I guess my question is, do we fall under the grandfathered clause since the condo was grandfathered, or do we fall under the non-residential, primary residential, because we're not primary residents to that condo either?
I guess when was the condo built?
It was 1968, which would be the grandfathered, because we were told now that we're not grandfathered, and we're seeing the increases as they come now.
Yeah, well, you're probably in a condominium building that's receiving the subsidies rather as opposed to the grandfathering. So as I had on one of the slides, the provisions for phasing out the subsidy on the multifamily and the condominiums has not yet been implemented.
But we are seeing increases now through our insurance companies, and we've just got an increase in the HOAs for that reason.
Well, now, understand that there are annual rate increases that are not related to Bigger Waters. Well, in fact, one of the other things that Bigger Waters did was it raised the ceiling for how much the annual rate increases could be, raised it from 10% a year to 20% a year. So that was another thing that Bigger Waters did in terms of changing the normal rating structure.
Yes, ma'am. Well, Danny, let's go up to this young lady.
He's going to get his exercise today.
No, I know you can't. I'm just being a gentleman. I'll hold this, please.
Okay.
Thank you.
All right, thank you. You stated that after January 1st, 2013, the 25% rate increases took effect, and yet people have had policies go up by 400% and 500%. How would you explain that?
I guess I would have to look at the policy itself and whether they had a policy in force as of July 6th of 2012. Okay, so now, we can't discuss the specifics about anybody's particular policy in this forum. But I would like to get the specific information from any policyholder who has specific individual questions about their policy. If I could get that information from you after the meeting, I'll be outside.
Sandy, let me just, if we could in a nutshell, when does it just go up 25? I shouldn't say just, but it's still a lot. But when does it go up 25? And then when does it go to full market rate? What's the circumstances? I know you covered. Is there a way to explain that where most people could understand it? Because there was a lot of slides up there.
Okay.
'Cause there's a lot of confusion about that. They hear the 25, then they hear it goes all, then they get the 500% increase.
Okay, for the pre-firm primary residences, those will only be getting the normal rate increases that are made annually if the rates are adjusted, which they have been for the last few years. So what's changing? If the policy is, now all of these are pre-firm buildings, those older buildings that were built before there was the availability of information to know how to build to make that building reasonably safe from flooding. those older buildings, if they did not have a policy in force July 6th of 2012, and they bought one after the date of passage of Biggert Waters, starting in October, they will get a renewal notice that will put them to full actuarial rate. And that may explain some of the people that are having the really big increases. Now, the people that have non-primary residences, the older pre-firm structures that are non-primary residences, in other words, you live in it less than 80%, you or your spouse live in it less than 80% of the year. At renewal, that policy will see a 25% increase. The non-residential buildings, the commercial, the older buildings will get a 25% increase at renewal. Now, if somebody is buying a new policy for the first time, if they're selling or buying one of these older pre-firm buildings, the rates will go to full risk rate at the time of the closing.
Let me add just quickly on the primary residence, because we have a lot of people here stay 6 months in a day. Why did they go with the 80%? Just out of, I don't remember offhand. Why did they go with the 80 instead of the 50, 6 months plus a day?
The primary residences, this was something that was always considered in terms of when they pay the claim. So if it's the primary residence, they, if you have 80% or more of the structure value, you get replacement cost coverage if it's your primary residence. So I think they were tracking it with, trying to make it consistent with other aspects of the policy.
All righty.
Right here, sir.
Yeah.
Hi, two quick questions if I could. One, you spoke about the pre-firm homes, and I understand that if the home is sold, that there's an immediate rate increase for the new buyers. What about the grandfathered homes? You said that the rate increases kick in October of this year. What if a home is sold in early 2014? Does the new buyer get the benefit of whatever the grandfathered rate is?
Yes.
Okay, and then
Until that provision of Biggert Waters is implemented.
Okay, and then it would kick up 20%.
And the community has a map change.
Okay. And this is a sort of broader question on FEMA's affordability study. You know, obviously there's the first derivative impacts, you know, the increased insurance rates, but is FEMA going to be looking at sort of the second derivative impacts? So home prices decrease, there is an impact on tax revenues to the communities, there's economic issues with the real estate market. Is that going to be included in FEMA's affordability study, or is it only going to be on the impact to the homeowners themselves?
I regret I don't have any information on the details of the affordability study.
I'm
Yes,
one
sir.
of the people that owned a property prior to July, and I went from $998 to $5,600, and I've already paid that. So we were going to try to get a vote, or Vern, what exactly is the plan, or to delay this, or we're going to wait for a report, or what is your
The
objective?
current legislation that we're proposing is we want to get an affordability study. We were promised that as part of the law. For one reason or another, we didn't get it. So with the idea that we keep the rates in place and get the affordability study and then figure out how to go forward. My idea of affordability study is something that makes sense. Not your rate increase, 25% is high, but people could maybe live with that, some people, but 500% is just completely unacceptable. I just think so we're gonna,
no
you know, they're
notice or
trying to
anything,
implement what they feel was, you know, the law requires. Unfortunately, we didn't get the affordability study, but as members, Democrats and Republicans, we're gonna look to change that. And, you know, that's our goal. That's gonna be up there this week fighting for.
Yes, Tom Cavanaugh, council member for the city of Punta Gorda, Florida. Wondering if any kind of special consideration has been given to historic areas or historic districts. We have a huge amount of properties in our downtown area that are in a historic district that are below flood. And as the insurance premiums increase, a lot of people, when the houses have changed ownership, they'll be obligated to probably take the house down, build at a higher elevation, and then lose that historic designation.
And I did have, in a bigger PowerPoint presentation, more lengthy presentation, I did have a slide on historic structures and the impact. And historic structures will be impacted by implementation of bigger waters, because I don't know whether everybody knows, the flood insurance program to this point has given special consideration to historic buildings, provided that improvements to those buildings did not jeopardize its standing on the national, state, or locally recognized historic register, and those buildings could obtain flood insurance at that pre-firm subsidized rate. That will end with bigger waters. Only primary residences that are historic structures will be still in a position of being able to take the subsidized rate. Now, I should point out, in terms of discussion, in most cases, the subsidized rate has to this point been a more cost-effective way for older buildings to be rated. However, it's always been an option to have an older pre-firm building actuarial or elevation rated if that gave the building a more favorable rating.
Peter Laughlin, two questions. The first one is that I think you mentioned that since 1978 that Florida received about $3+ billion in payouts. Could you tell me how much premiums were received during that same period?
I think I have that in some information, but I'd have to look it up.
But is it above $3 billion?
I don't know without looking at.
Okay. The other question is that we talk about the change of maps. It's kind of a strange type of situation. You build a home or building at the current rules that exist with regard to the floodplain on certain maps. Then you're creating new maps now, which will affect that particular building. What criteria is used to decide on those change of maps? And also to who makes that decision, and how fair is that?
You want me to take that one?
Go ahead.
Okay. First of all, technology, regulations typically always go higher. We know more, we tell you more. So in the case of Sarasota County, we are selecting a nationally approved modeling. We work with SwiftMud. FEMA has the ultimate approval, but we have input. Where have we flooded, our flooding history, and the science. We use something called LIDAR now, which an airplane shoots down and can tell a 6-inch depression. So our methods and sciences continually improved to give you a better risk calculation. So it hasn't always been prompt. Sarasota has some 20-year-old maps plus, but these shortcomings that will always be in a new product and an old product are always disputable by the property owner through a letter of map change. So nothing's going to be perfect, but what I guess the key point here, and I sympathize with the gentleman going up to 5,000, and bells went off in my head. Oh my gosh, your property is well below base flood elevation. So it's knowledge. It's not always a good message, but it's a piece of information that I think you deserve as a property owner.
And let me just ask along that line, if you're below and above on the same piece of property, what is the difference in the premium ideally? Or is there a percentage, or just what's your experience?
Okay, the premiums are 16 pages long. I've tried to look at them. I'm not an insurance, but in Sarasota County, I can tell you that When someone goes to build or they're going to improve their property, if there are two zones or two pieces of data, we take the highest risk in order to protect the person the most. There are sometimes 250-foot margin of errors. So when I say it takes an individual look at what's happening, but in Sarasota County, we take the highest risk. And perhaps.
In this gentleman's case,
Mhm.
and I don't know if someone was paying 1,000, obviously he was below, now he's going to 5,600.
Yeah.
Is there that much of a difference for a home that's below and above?
Yes.
There should be some kind of a, percentage, because people ask me that, I don't know what the answer is, just in the ballpark, I'm not trying to hold you to anything.
Right, and I don't know how they do the percentages, but for each foot that you're safe, that base foot, I'm safe.
Yeah.
And then every foot higher up to 3 foot, you get an extra discount. In other words,
Your rate
if
goes
you're
down.
really 3 foot above where it's going to hit, you should be paying between $300 and $500 a year. Anything above that, it is a signal to me, from my experience, is that there's a problem there. And maybe you can talk about the premium.
All right,
Well,
go ahead, Jeff.
in terms of the premium, and we've got a real simple rate calculation, and I can share that with you after the meeting, but basically, every foot of freeboard reduces the premium that's calculated because the risk is reduced. That's the whole idea of the risk-based rates. And so if you were building a new building, for every foot you can go up, the first foot of, we call it freeboard, taken from the marine term for the, the part of the boat that's above the water line. For every foot of freeboard, the first foot of freeboard reduces the rate as much, or the premium as much as 45%. 2 feet reduces it even further. The rates currently peak out at 3 feet above the base flood elevation. Now, the problem is that going the other way, the current rate tables only go to a foot below base flood elevation because, of course, knowing what the risk is, the community, through its floodplain management program, is not supposed to be allowing construction below the base flood elevation. But the rates do go to a foot below. Now, once again, oftentimes people, when they find out how much increase the rates are going to be based on that 1 foot freeboard, let's say they go to the city and ask for a variance to go build 1 foot lower than they should. Oftentimes the community's floodplain administrator, like Sandy, could give them that information to know that, well, where you may have a justifiable reason for that 1 foot variance is really going to be costly in terms of your insurance, and you'll be paying this for, the life of your mortgage loan.
When we approve variances, and typically we only do them for historical, since I've been doing floodplain management since 99, there has only been one variance that was granted in Manatee County that was for a post-firm structure. And it was not a variance from the base flood elevation, but it was a variance from Manatee County's freeboard. We have to give the customer or the homeowner a disclaimer that for every $100 coverage they have, they could pay up to $25 more
But you're
if
saying,
you go for a variance.
you were saying that, you understand the first foot is 45% reduction.
Yes.
Jeez, it's a big number.
No, and the disclaimer is that for every $100 worth of coverage, it may be $25 for every $100. That
If you're below base
expensive.
flood.
The
if you're below
important thing
base
you're
flood.
making is that if you're building new construction ideally, or you're
Correct.
buying a structure, the higher you can get it up
Yes.
3 feet, the better. Yes, sir.
Hi, Tony Romanis, CS to Key. My question's about the program as a whole. From what I've read, over 30-plus years, Floridians have paid in a lot more in premiums than they've gotten in claims, and yet we're seeing very dramatic increases in the premiums coming. So I'm curious, first of all, where's the money going that has caused such the big deficit in the program, and in those areas, are they seeing even more dramatic increases than we're seeing here in Florida?
Well, as the representative said, many of these, much of the deficit is as a result of Hurricane Katrina and Hurricane Sandy last year. So this is a national flood insurance program. In other words, the rates are not based on Florida. They are structured nationwide. So for the same building type, same construction, same foundation in the same zone, you will be paying the same rate here in Florida as you would in California or New York.
Yes, sir.
I'm Jeff. I have a question. I'm a local insurance agency owner here in Sarasota, and as of last month, we were actually approved to sell a private flood insurance policy. I'm just curious, are you guys doing anything to promote private flood insurance versus the FEMA policy, especially for the high-risk A and B zones that are at or below where they should be?
In Sarasota County, our purpose is that you're protected, the community's protected, the state. So as far as who you choose for an insurance provider, as long as you have insurance in place, that's kind of the education there. It could happen and you're protected.
Well, one thing I would just say, whether it's right or it's wrong, I mean, what I've read in the papers, and maybe it's more Sarasota County, but it's a big percentage of Manatee County. I think I heard as high as 60, 70% that are people that are coming by buying homes or cash buyers. And I'm hearing a lot of them, if they get a big number, they're self-insuring. Now, whether that's right or wrong, I'm just telling you what I hear, because at some point you say, this isn't right, it's not fair. I'm built up, my house isn't the one I bought, it's not that old. I'm willing to take the risk, and now that's not for everybody, and that's, and a lot of what we're talking about is for people that can't do that, but I will tell you that as it relates to a lot of home buyers, there are a lot of cash buyers from the Midwest or wherever they're coming from buying homes that way.
Thanks for having the panel today. I'm Joe Murphy. I'm a realtor here in town. What was the cause? I have two questions. What was the cause for the 30-day delay for implementing the waiting period for a flood policy? And why was on my higher risk properties, we used to be able to transfer the policy, the existing policy to the new owner, which helped a lot. Those are my two questions.
Well, the 30-day waiting period was actually something that was increased by the Congress back in 1994 with the passage of the National Flood Insurance Reform Act. When I first came to work with FEMA, the waiting period was a 5-day waiting period for the policy to become effective. Now, we observed some really interesting things where, people would, I'll give you an example. People in northwestern Mississippi would watch the Mississippi River gauge at Cairo, Illinois, and they knew exactly how high the river gauge had to get before they figured they needed to run to their insurance agent and get a policy, knowing that the water would get to them within about 14 days. So the policy, they would get the policy, they would have the policy in place by the time the water got to them, so they would be able to make their claim, and then, when it renewed, they just wouldn't renew it, until the next time it looked like the Mississippi River was going to flood. So I think after the 1993 Midwest floods, if you remember those, it was when the Congress in 1994 passed the National Flood Insurance Reform Act that increased the waiting period from 5 days to 30 days. Now, there are two exceptions to that, and one is if for closing, the policy can go into effect at the closing without a waiting period. And the other exception to the 30-day waiting period is when the policy is being required due to a map change, and the mortgage lender asks the policyholder or the property owner, the borrower, to get flood insurance coverage when they didn't have it before. So it goes into effect in 1 day then.
Let me take a couple more questions, and I'll ask the panelists to stay around. I've got to be back in Washington to vote this afternoon at 4 o'clock, so I've got to kind of get, so I can take a couple more questions, but hopefully the panelists can stay around and ask any other questions. Yes, sir.
Thank you. David Parker, Sarasota, Florida. With regard to Sarasota County, we have a rating of 5, which gives us that 25% discount. And because the implementation of BW, what can we do as a county to increase our rating to above 5, in other words, reaching for 1, that could give us greater discounts considering the circumstances we're in now?
A 1's really tough.
Yeah.
We're a coastal community. We have almost 100,000 acres of floodplain. A lot of that's been built on. And we're coming in after the fact to try to fix things. We've learned through many flooding experiences that engineering projects don't fix everything if the structure's been built below base flood. So, with that said, we try all the time to strategize how we can do better. Part of it's these individual site visits, resources. I'm trying. We could, if we update our maps and have digital products that can give us 600 to 800 points. We've been waiting for that for quite a few years. So we always think about it. In fact, this last year when I went to the board, I told them we may drop because just as the NFIP program changed, CRS had its first huge revision of point allocations. So we're still working on that. But thank you.
Yeah, Mayor Monty from Holmes Beach, Florida. I noticed you mentioned for the CRS that Anna Maria, the city of Anna Maria, was different than Holmes Beach, Bradenton Beach, and Longboat Key. Why is that?
They're all individual communities in the National Flood Insurance Program. They each have their own community numbers, so they each have their own CRS program.
And so Anna Maria is a CRS Class 5.
What is that based on? What's the criteria to make a distinction between
The activities that you have chosen to implement in Anna Maria. The CRS creditable activities, and there's a whole range of activities, everything from, and help me out here, Des, everything from outreach to
Freeboard,
freeboard,
stormwater maintenance,
It's
drainage.
an overall view of your best practices for floodplain management measured nationwide. So we're competing with people in Colorado or an area that may have 1 acre of floodplain and no structures. But it's our best practices, and there's actually like 98 things. It's anywhere from beach renourishment to open space to education. Yes. Yeah. And you can look up more information on that if you go to www.fema.gov and search CRS. There's a 693-page manual, and all of the communities in the United States are rated.
Last question here, sir. It goes into great detail.
Yes.
Susan, thank you very much for your presentation. It was excellent.
Thank you.
My name is Lou Costa. I am a retired principal engineer working for Raytheon Company on the Patriot Missile Program. The major concern here at this meeting is the extremely high cost of flood insurance on those older homes built prior to 1974, similar to the one that the gentleman over here is talking about. He is only the tip of the iceberg. Most of the homes on these barrier islands all fall into his situation. They just haven't come up yet. What we need to do is focus on finding a solution to reduce the cost, okay, of insurance. We need to find win-win solutions to reduce the cost. Now, the state of Florida had this same similar problem with hurricane insurance. They resolved it and they found a way of getting reasonable insurance to all of us, okay? And if you look at it carefully, what you pick out of it is the way they do their deductibles. They have a totally different method than the method FEMA uses. They use a percentage method, okay? So I'm going to give you the example of my house personally. My house, I have $250,000 coverage, okay, my hurricane insurance is $2,000. My flood insurance, it's in the same risk zone, is $6,000. All right, now, if you look at the information given out by FEMA, okay, when they go up to a $5,000 deductible, that premium drops by $1,300. So if we were to use the same method that the state is using, where they have a 5%, that allows them to have a $12,500 deductible, theoretically, the premium for flood insurance will drop down to $2,000, exactly equal to what the state has for the same zone. It's as simple as that. There's nothing complicated. It's a case of we're using the wrong method and the wrong formula. So the one question I have for you is, why doesn't FEMA allow an option of a higher deductible than $5,000?
And I think that is one, increasing the deductible options is one of the things that FEMA is considering. That's
how the state of Florida solved their problem.
I will pass that information along to the folks at Washington.
Let me just say, first off, I'd just like to thank our panelists. Let's give them a round of applause for coming in. Personally, I agree with the gentleman. I think this gentleman back here has got a $900 policy going to $5,600 is not acceptable. And I'm personally committed to, with other members in the state of Florida, to dealing with this makes sense. This makes absolutely no sense. It will hurt our community. You can't have people spending the kind of money he's spending on his example. Those homes are going to depreciate substantially in value, and we have a lot of them that are built in the 50s and 60s that are out there. They're, you know, a lot of them are some more expensive than $250 or less, but it takes a lot of people out of their original home. It's just not acceptable, and we've got to find a way to work with FEMA, and that's why I want the affordability study. And what that means to me is something that's affordable going forward. You've got my commitment. We're going to continue to work on this hard. Thank you. God bless. And they're going to be around. Hey, Danny. Danny, where's Danny at? Is he taking a nap? Oh, I was going to say, for those, why don't we take it because it's working well. Why don't you, there's other people got other questions and comments. Go ahead and continue to use the mic, and you can take my place. All righty? Anybody like to?